Welcome to Factful Finance, where we break down complex financial concepts into actionable insights. Here's a question. How many of you have ever felt the thrill and uncertainty of investing? You put your money into stocks, bonds, or real estate, hoping for returns. But there's always that nagging feeling in the back of your mind. What if I lose it all? Well, today we're diving into strategies that can help reduce investment risk so you can invest confidently. Before we get started, just a quick reminder. This video is for educational purposes only. For personalized guidance, always consult with a professional. Investing always comes with some level of risk. But the good news? There are ways to manage and reduce that risk. Let's walk through some key strategies you can use to protect your hard-earned money. First up, diversification. Think of your investments like a fruit salad. If you only have apples, and apples go bad, you're stuck with nothing. But if you have a mix of apples, bananas, and oranges, you're less likely to be affected by the downfall of any single fruit. When you diversify, you spread your investments across different asset classes, stocks, bonds, real estate, and even international markets. This lowers the risk because different assets often perform differently under varying market conditions. Experts recommend having at least 20 to 30 different investments in your portfolio. Let's take Sarah, for example. She's been saving for retirement, and she started off by putting all her money in tech stocks. When the tech bubble burst, she lost a good chunk of her portfolio. But after that, she learned about diversification. Sarah spread her investments across bonds, index funds, and even some international stocks. As a result, she didn't experience the same drastic downturn when markets fluctuated. Her portfolio stayed more stable and continued to grow, despite the inevitable market dips. Second, we have asset allocation. This is a strategy that focuses on dividing your portfolio into different asset types based on your risk tolerance and time horizon. Let's say you're young and have decades before retirement. Then you can afford to take more risk with a higher percentage of stocks. But if you're nearing retirement age, a more conservative mix of bonds and stable assets would be prudent. The goal is to strike the right balance between risk and return. For instance, John, who is 35, has a higher proportion of stocks in his portfolio because he has the time to recover from short-term losses. However, his cousin Mike, who is 58, invests more heavily in bonds, knowing that he doesn't have the same time to recover from downturns. Your asset allocation should evolve as you approach major life milestones. Next, let's talk about rebalancing. Over time, your portfolio's allocation might drift from your intended strategy due to market performance. For example, if your stocks outperform, they could make up a larger portion of your portfolio than you intended. This is where rebalancing comes in, adjusting your investments back to your desired allocation. Experts recommend reviewing your portfolio at least once a year and making adjustments to stay aligned with your goals. Take a look at Emma. She started with a 60% stocks, 40% bonds mix. A year later, the stock market had a great year, and her stocks grew to 70% of her portfolio. To get back to her target allocation, she sold off some stocks and bought more bonds, maintaining the risk level she was comfortable with. Rebalancing ensures you're not overexposed to a specific asset class and helps keep risk in check. Risk management tools like stop-loss orders are also crucial in reducing risk. A stop-loss order automatically sells an investment when it reaches a certain price, limiting losses if a stock or asset drops too sharply. This tool is especially useful for individual stocks and can help you avoid deep losses during market downturns. Now, let's talk about the importance of investing in what you understand. One common mistake many investors make is jumping into trendy or complex investments they don't fully understand. Think back to the cryptocurrency boom. Many people invested without fully grasping how the market worked. Instead of chasing the next big thing, it's wise to stick with investments you comprehend. If you're unsure about a particular asset or market, it's worth doing extensive research or speaking to a financial advisor. Finally, don't overlook emergency savings. Having an emergency fund gives you the cushion you need to avoid selling investments in a panic during market downturns. If you have enough cash on hand to cover at least 3 to 6 months of living expenses, you won't have to touch your investments when the market gets shaky, which helps you stay invested for the long term. So, let's quickly recap the strategies we've covered. 1. Diversification. Spread your investments across various asset classes to lower risk. 2. Asset allocation. Adjust your portfolio based on your risk tolerance and time horizon. 3. Rebalancing. Ensure your portfolio stays aligned with your goals by adjusting regularly. 4. Risk management tools. Use tools like stop-loss orders to minimize potential losses. 5. Invest in what you understand. Don't invest in things you don't fully comprehend. 6. Emergency savings. Have a buffer to avoid panic selling during downturns. What's the first step you'll take toward reducing your investment risk? Let us know in the comments below. And if you like this video, why not hit that subscribe button so you don't miss out on more expert financial tips. Thanks for watching, and we think you'll find the video shown on screen next helpful in reaching your financial goals. Until next time, stay informed and keep investing wisely.